S&P Global's new report projecting demand for lithium, nickel, and cobalt is going to increase 23-fold by 2035. The report also highlighting, as Pippa just mentioned, that meeting that demand is going to be a challenge under the IRA's sourcing requirements. Dan Yergin, welcome. So this reminds me of No Child Left Behind, right? I used to cover education. And it's like you have these standards that look good on paper, but they actually get harder and harder to meet over time, and eventually something breaks. Is that what's going to happen here?
Well, I think actually you've got it. I mean, we count over $400 billion of commitment to investment, of which Pippa showed some of that on batteries since the IRA. But that means many, many billions of dollars of additional demand for minerals, which are the building blocks of the energy transition. And the challenge here, as you say, is that these sourcing requirements are on top of the increased demand. And the sourcing requirements are basically meant to reduce that dependence on China, which has such a preponderant position in the entire supply chain for minerals. So what's going on right now is to figure out, well, how do we, we only can do things with free trade countries. So do we get some kind of quasi-free trade agreements with Europe and Japan and other countries that will enable some flexibility so that these very rigid requirements don't lead to a shortage?
Well, on the surface, it would seem like the thing to do is bet, okay, well, these minerals are going to be in great demand, and so surely the price of them is going to go up. So, trade commodities and bet that the price is going to go up. But this is a global market, and not everybody's got these same restrictions. So is that necessarily going to happen? Is the price of these minerals necessarily going to rise?
Well, let me put it this way. There's certainly going to be pressure on supplies. One of the things in our study, which was very dramatic, we looked at 127 mines that have been built, and we saw that basically, if you started today a major mine for minerals, it would not come online until the 2040s. So that tells you if you're going to have all this demand really increasing, there's going to be pressure on supply, and then that means competition, not only with China, but also with Europe. And we have to work around these FTA things in order to achieve these goals. So that's why we say it really is a big challenge, and getting the rules to function is going to be very significant to be able to attain these goals.
How great is the risk that we're wrong about what demand is going to be like in 12 years? Could technology shift in such a way that some of these minerals are less in demand, not that there's no demand for them, but less in demand than we today expect?
That's a great question. And I think with any forecast, it's a very good thing to always say, what will you be wrong about? So what would make these kind of expectations? Number one would be much slower economic growth, kind of disruption in the world economy, the kind of breakdown of globalization. Number two would be, there'll certainly be a drive for recycling, but that's going to take time and money to do it, and also permitting issues. So the thing that you're pointing to is innovation, because certainly what's out there is find an alternative solution. And I think even as it's flashing red for automakers and others, where do you get your supplies? People are going to be looking at what are the alternatives? How else do we work around this? And this may come from left field and surprise us. But we are dealing with a fairly short time frame, and innovation generally takes longer than that. But the incentives are certainly there.
So let's talk about lowering investors' risk here then. It seems like the best bet would be on companies that invested in mines that are going to come online within the next 3 to 5 years, and probably the technology and demand picture, it might not change that much over the near term. So regionally, and even when it comes to companies, do you have a sense of who's got the most mines for these critical minerals that are about to come online but not online yet?
I wouldn't want to get into specific companies, but I think what you've seen is the big miners are focusing on optimizing output from existing mines. They're going to be looking at acquisitions, add-ons, and so forth. And there doesn't seem to be, there's not a big appetite, maybe this goes to your point, to really start big new mines somewhere in the world, because also these involve long negotiations with governments. Permitting is not only an issue in the United States, it's an issue around the world. So I think it's going to be people who optimize. I've been with smaller miners in the United States. I was at a meeting with them recently in Washington. And, what's holding them up are the permitting challenges, which seem to be endemic to every part of the energy spectrum.
Indeed. And it makes me wonder if there are any countries on the bubble who might be encouraged to make a free trade agreement based on this. But I guess we'll see. We'll have to leave that for another time. Dan Yergin, great insight. Thank you.